Hi, in earlier videos I have spoken about the drivers of return on equity, which is net income by shareholder funds, which can be broken up into net income by revenues, which is the net margin, into revenues by assets, which is the asset turnover, and the third factor, which is assets by shareholders equity, which captures the financial leverage. I've spoken about the trade-offs between the asset turnover and the net margin, which can be made depending on business decisions. The last factor, which is assets by shareholder equity, can also be written as capital employed by shareholder equity, that is debt plus equity divided by equity. So if total capital employed is 3,000 and shareholder equity is 1,000, that means this factor is 3 and the debt equity of the company is 2:1. So even if you come to the same final return on equity, let us say two companies have the same return on equity of 20%, if the difference is in this last factor, which is leverage, you are not neutral between the two. That means one company's return on capital employed has been enhanced by taking higher leverage. So if one company has a leverage of 2:1, this last factor will be 3. If the other company has a leverage of only 1:1, this last factor will be 2. So that, in a sense, taking a higher leverage is not an ideal condition, which is not to say that all companies should have zero debt, but debt does increase the riskiness, and therefore you should take on only debt which you can service comfortably even during a downturn in the business. So all else being equal, if the final return on equity is the same, you would prefer a company which has gotten there with lower leverage rather than one which has gotten there with higher leverage. Of course, we are talking about companies within the same industry because leverage can vary widely between industries. So let me know what else you would like to know about this.